Your savings account is paying you 4% right now, and the bank is quietly making 40% on your money. Same money, same account, same day. This is not a glitch. It's not a regulatory loophole. It's the actual business model, and it's been hiding in plain sight for over a century. Here's what we're going to show you today. That 4% is real, but it's also a decoy. And by the time this video is over, you'll understand exactly how the spread works, why the bank needs you to feel satisfied, and where to put your money once you know the game. This video is for educational purposes only, not financial advice. La jonge format byorende there's a vikomin a lower de mergormin may. Don't man do in a year. At thamel see her who made the merpa that were made about sis me. There are me up a newspaper and mommy and dad mom down mingdal some. I'm gears air my bell saudi. They get them hey. Think you we when you renew now in Montes, Diabo and China will wangers day. They go sucked up for a member new, be maple must darts and as a women down business they never go nervous. In 2023, the average high yield savings account in the United States was paying around 4 to 5%. That felt generous. After years of near zero rates, it felt like the bank was finally on your side. But here's what was happening at the same time. The largest banks in America, JP Morgan Chase, Bank of America, Wells Fargo, posted combined profits of over $80 billion in a single year, while paying their depositors 4%. So how does that math work? Here's the mechanism. When you deposit $1 into a savings account, the bank doesn't just hold it. It puts that dollar to work. It lends most of it out as mortgages, auto loans, credit cards, commercial real estate debt. The interest rate on those products is almost always dramatically higher than what you're earning. The 30-year fixed mortgage rate in 2023 averaged around 7%. Credit card rates averaged over 20%. Small business loans routinely carried rates of 8 to 12%. Your 4% is the bank's cost of goods. Everything above that is margin. Now, which of these feels most familiar to you? Are you sitting in a high-yield savings account right now, or in a standard savings account paying almost nothing? Drop it below, because the gap between those two options is actually the first place the system gets you. Here's where it gets interesting. The bank isn't just lending your money at a higher rate. It's doing something more powerful than that. It's lending money it technically doesn't fully have yet, and the Federal Reserve is the mechanism that makes this legal. This is called fractional reserve banking, and it's been the backbone of the American financial system since the Federal Reserve Act of 1913. Here's how it actually works. Under rules set by the Federal Reserve, banks are required to hold a fraction of their deposits on hand as reserves. In March 2020, the Fed actually dropped the reserve requirement to 0% for most deposit categories. Zero. That means for every dollar you deposit, the bank can theoretically lend out $1, collect that borrower's payment into a new account, and lend most of that out again. Economists call this the money multiplier effect. A single deposit of $100 can support $700 to $1,000 in total loans across the banking system. The exact number depends on how much banks voluntarily hold in reserves, which they park at the Fed overnight and earn interest on through what's called the federal funds rate. So let's follow your dollar precisely. You deposit $1,000 in a high-yield savings account at a large bank. The bank pays you $40 a year. 4%. That's your 4%. The bank takes the bulk of that deposit, and because of how the multiplier works, it eventually supports somewhere between $7,000 and $10,000 in loans at an average blended rate of somewhere around 8 to 10%. That's between $560 and $1,000 in interest income generated from your original $1,000 deposit. They pay you $40. They keep the rest, minus overhead, minus defaults, minus what they park at the Fed. That gap between what they earn and what they return to you is called the net interest margin. And for the largest U.S. banks, that margin has historically run between 2 and 4% on their entire book of assets. On a balance sheet of $3 trillion, which is roughly what JP Morgan carries, 2% net interest margin is $60 billion a year in profit from the spread alone. Now here's the part that changes how you look at this. The 4% APY is not the bank being generous. It's the minimum price they have to pay to keep your deposit in their building instead of a competitor's. It's a retention cost. They need your money parked there so they can use it. The moment a competitor offers 4.5%, they raise their rate slightly, not to reward you, to keep the raw material in the factory. This is the decoy. The 4% feels like the win, but the actual win is the spread. And here's something most people never connect. The Federal Deposit Insurance Corporation The FDIC insures your deposits up to $250,000 per account, per institution. That insurance exists precisely because this system creates a vulnerability. And ominous at right the Imer, any Brad and never bid the Indian Warner padded, which many people I said up for the kids ping Immer Green at begin at bring data of a state who website paid ray out the begin serve Mr. Day in reading that dammer big K. And bit some every cycle of our peg me out different is how say that he said that dark and bars memory devon six the spade and pine real ping search said and no words device of white quivers mean how the airs who are stepper they say where is a goods but sorry they're gonna be. How worried having been what Sue having and the barry bear sin. Inventory say about their safe. SVB held about $209 billion in assets and collapsed in 48 hours once depositors lost confidence. The FDIC stepped in. Your money was protected, but it illustrated in real time how the whole structure depends on you not asking for your money back at the same time as everyone else. If understanding how the spread works changed how you see that APY number, subscribe and stay here. We break down one financial mechanism like this every single week. Not for people who already have the answer. For people still building toward it. Now here's the move most people don't make. Once you understand that 4% is the bank's minimum retention cost, the next question becomes obvious. Can you cut out the bank and lend directly to the borrower at a better rate? The answer is yes. And the borrower is the United States government. Treasury bills, T-bills are short-term debt instruments issued directly by the U.S. Treasury. In 2023 and into 2024, 3-month and 6-month T-bills were yielding between 5 and 5.5%. That is a full percentage point or more above what most high-yield savings accounts were offering, with the same or better safety guarantee, because T-bills are backed by the full faith and credit of the federal government, not just the FDIC insurance cap. You can buy them directly at treasurydirect.gov, or through a brokerage like Fidelity, Charles Schwab, or Vanguard with no fee. But here's the detail most people miss on T-bills specifically. The interest you earn is exempt from state and local income tax. For someone in a high-tax state like California or New York, where state income tax can run 9 to 10% or higher, that exemption makes the T-bill's effective yield meaningfully higher than a savings account paying the same nominal rate. Let's run the actual numbers. If you're in a 32% federal bracket, and a 9% state bracket, and you earn 5% on a T-bill versus 5% on a savings account, the T-bill puts more money in your pocket after taxes. Every single time. Because the savings account interest is subject to both. Now the bank knows this. So why doesn't the bank tell you? Because the bank is the intermediary you're cutting out. Every dollar that goes to Treasury Direct is a dollar they can't multiply through fractional reserve lending. Your awareness of this alternative is a direct threat to their margin, so it stays quiet. Here's the second thing most people don't do. Money market funds. A money market fund is a mutual fund that holds very short-term, high-quality debt, including treasury bills, government agency debt, and sometimes short-term corporate paper. Funds like the Vanguard Federal Money Market Fund, ticker VMFXX, or Fidelity Government Money Market Fund, ticker SPAXX, were yielding around 5% in 2023. They're not FDIC insured, but they're considered extremely low risk, they're liquid, and they hold assets directly rather than acting as an intermediary profiting from the spread. There's one more layer here that almost nobody connects to their savings behavior, and it has to do with the federal funds rate. When the Federal Reserve raises or lowers the federal funds rate, what it's actually doing is setting the rate banks charge each other for overnight lending. That rate ripples outward. It determines what banks earn for parking reserves at the Fed, which influences what they're willing to pay depositors, and it influences what they can charge on loans. The spread doesn't shrink when rates rise. In many cases, it widens. Because banks adjust loan rates instantly, they adjust deposit rates slowly, reluctantly, and only as much as competition forces them to. There's even a name for this in banking economics. It's called deposit beta. It measures how much of a Fed rate increase actually passes through to depositors. In the 2022 to 2024 rate cycle, research from the Federal Reserve Bank of New York found that deposit beta at large banks ran well below 50% for most of the cycle. Meaning if the Fed raised rates by 4 percentage points, depositors at large banks received, on average, less than 2 percentage points of additional yield. The rest stayed with the bank. Community banks and credit unions, because they compete harder for local deposits, tended to pass through more. Online-only banks like Ally, Marcus by Goldman Sachs, and American Express high-yield savings competed on rate by design, which is why their APYs tracked closer to the Fed funds rate throughout the cycle. So what's the actual takeaway from the deposit beta number? The bigger and more convenient the bank, the more of the Fed's rate increase they kept. The less convenient the alternative, the more yield you had to go find yourself. That is the precise cost of convenience, measured in real dollars, sitting in their building instead of your pocket. So here's where some people in this situation draw the line and take two concrete steps. The first one is to compare your current APY against the current 3-month T-bill rate. You can find that at treasurydirect.gov or just search current T-bill yield. If the T-bill is yielding more than your savings account and your savings is sitting above the $250,000 FDIC limit, moving some of it to T-bills gives you better yield, better tax treatment in most states, and zero counterparty risk from any single bank. The second step is to check the deposit beta on your specific bank. The fastest way is to look up your bank's savings, APY history over the last 2 years, and compare it against the Fed funds rate moves in the same period. If your bank raised rates slowly and cut them fast, you know exactly where you stand in their priority list. Some people also look at money market funds inside their existing brokerage as a place to park cash between investments, specifically because that cash earns yield without sitting idle in a low-rate bank account. At brokerages like Fidelity or Schwab, the default cash sweep account is often a money market fund already. But not always. It's worth checking what rate your uninvested cash is actually earning. Here's the thing. The 4% was never the enemy. The bank needs to pay you something to keep the raw material in the factory. But now you know what the factory makes. And you know the alternatives that exist every single time the Fed raises rates. The decoy only works if you don't look behind it. Which piece of this surprised you most? The deposit beta number, the T-bill tax treatment, or the size of that spread? Let us know below, because that shapes what we cover next. And if you want to understand the next layer of this, how the Fed actually sets that federal funds rate, why it moves, and who it really protects, that one's already on the channel.